What is a fixed indexed account? What is an FIA? That is the question that I receive from people on a daily basis. And I always tell them a fixed index account is the absolute best place for your retirement money. And if I were you, I'd be asking the question, Richelle, why are you saying that? Well, it is my firm belief that your retirement money should not be on the stock market. Well, Richelle, everybody's retirement money is on the stock market. Why is it that you're saying the opposite of what most people say? Well, think about it. When your retirement money is out on the stock market, what happens? You lose anywhere between 20 and 50% of the value of your money every single year to 2 years. And you'll have to work and put that money back at about 10% of your pay. So think about it, working and only being able to save about 10, maybe even 15% of your salary. You're trading time for dollars, hustling, getting up, going into work, and then trying to recover the money that you lost on the stock market. And then you said, well, Richelle, the stock market can take an upswing. Well, of course it can. But if you are not a savvy investor, what happens when it takes a hard downswing? That means that you're taking 6 steps forward to take 10 steps backward. And you're starting all over from the line of zero, or your money has gone back down to the line of zero. Suppose there was a way to eliminate stock market losses altogether. That means you're not recovering. Think about it. If you were to get hit by a bus and you went in the hospital, the doctor would put you in recovery, right? And you'd have to go through rehab and you'd have to recover back to your original health. You may or may not be in full health. Your body may or may not be the same as it was before you got hit by a bus. Think about your retirement money like getting hit by a bus. You've lost $100,000. Now you've got to do what? Recover that $100,000. You've got to put money back in there, and you've got to hope and pray that the stock market does what it should do in order to make some type of gains. Nobody wants to just recover. We want to win. Are you with me? Without financial literacy about the stock market, I want to tell you something. It is next to impossible to win. And when you have a stockbroker, that means you're going to have to pay that person exorbitant fees. You're going to have to pay them about 2% of every dime you have in your account for the rest of your life. And in order to get in the door to talk to them, a lot of them won't even talk to you or treat you with white gloves unless you have at least 250,000. Some of them won't talk to you unless you have $750,000 saved. So it is a tough place to break into to get the care and to get the education that you need. Are you picking up what I'm laying down? So when you are a beginner on the stock market, or you're an intermediate level in your financial education, which means you're not a day trader, but you do know a little bit of something about it. Beginner to intermediate level folks, should have a fixed indexed account or a fixed indexed annuity. Why? Because you get stock market gains and zero losses. The language you will hear is that you have upside potential and your money sits on the floor. The floor means you take no losses or you have a guaranteed interest rate built inside of your account. Stock market gains and zero losses. Fixed indexed account. Are you with me on that? Now, the A can stand for account or the A can stand for an annuity. An annuity is simply taking a lump sum of money and creating a passive income out of it. So again, an annuity is taking a lump sum of money and creating a passive income out of that money, also known as annuitization. So you want an annuity when you're ready to take an income from your lump sum. And hopefully, you want an income that will last for the rest of your life. So you want a guaranteed lifetime income. Are you with me on that? Those are the best types of an annuity. An account is where you're going to get growth and bonus money. So an account is a growth account. An annuity is an income account. Two different types of an account, growth accounts and income accounts. Are you with me on that? Let's take a look at the two different types of accounts. Stay with me as I share my screen with you. So I'm going to show you a modest annuity account. Okay? So let's take a look at a modest annuity account. Here is a client who rolled over $248,376.28 from her thrift savings plan. She decided that she could leave the money there and let it sit and grow in her annuity or her fixed index account, FIA. When the stock market crashed in 2025 due to the tariffs, she did not lose a dime. Her money sat on the floor of a guaranteed interest rate. And you can see here, she still earned $1,192.14 on her money. Are you with me on that? But when the stock market went back up again, she earned a modest 4.99% interest. So as you can see with the interest crediting in her account, she took modest stock market growth and zero losses. This made her feel much better because at age 64, she had already left her job and she could not afford to take any losses on her hard-earned savings. Now, she was in a position financially where she could leave the money and let it sit and grow for a few years. But when it was time for her to take her random minimum distribution at age 70, she said, Richelle, I must have a minimum of an additional $30,000 a year coming in at age 70. So we set it up so that she has a guaranteed lifetime income at age 70 of $30,550.28. Now, suppose she had taken that money to Charles Schwab or TD Ameritrade or Edward Jones and put it in a brokerage house. Well, during the time of the tariffs, she would have lost $50,000 or more just before it was time to retire. And instead of $148,000 and some change, her money would have dropped down to less than $200,000. And she would have been starting back over as if she would have lost a year and a half worth of her salary out of her account. Imagine being 64 years old in your retirement age and you've lost 30 to 50% of the value of your account. You're not able to work and put the money back in there because you're now living on a fixed income. All you have to do is suffer the losses. So we recommend that if you are in the retirement red zone, which means you are 5 years or less away from your retirement date, do not put your money on the stock market because you do not have the time to recover. Are you with me? So she smartly put her money in a modest annuity. And then at age 70, she is able to draw out a guaranteed lifetime income of $30,550.28. Now, this money is a fixed income guaranteed for the rest of her life. Again, let's say instead of doing the annuity, she decided to go to Edward Jones or Charles Schwab and put her money into a brokerage account. What would have happened? They would have done something called the 4% withdrawal rule, which means she would have been told she cannot withdraw or should not withdraw any more than 4% of the value of her account. Now think about it. 10% of the value of her account would have been $24,837 per year. Are you with me? 10% of that number. So half of that number would have been, what is half of 24,000? Divided by 2. She would have been told she would have drawn out less than $12,000 a year, less than $1,000 a month. And then she would have been withdrawing her account down to the line of zero slowly. Okay. So if you take a look at here, over here is the accumulation value. It tells you if she began to pull out $30,550.28 per year, she would have drawn her account down to the line of zero. And at age 80, she would be flat broke. But an annuity is a financial instrument that guarantees you a lifetime income. You have a contractual guarantee that you are going to get no less than this amount of money for the rest of your life. So this life insurance company is giving her a contractual guarantee that she will get no less than $30,550.28 for the rest of her life. So as long as she lived, even after she would have withdrawn her money down to the line of zero, she will still be guaranteed that $30,000 for the rest of her life. Now, if you have any questions about this annuity, I want you to drop them in the chat. And I promise that I will take a look at your questions and answer them for you. And if you have any questions that require you exposing any of your financial information, I'm going to ask you not to do that. I'm going to ask you to email those questions to me at Rhema, RHEMA financialcoaching@gmail.com. Now, there are different ways that we can structure this annuity. We can structure it so that it grows in value every single year. We can structure it so that it pays 50% of the value to the surviving spouse, so that if she passes away before her husband would get 50% of that annuity for the rest of his life. So there are many different ways that your annuity can be structured. It could pay you for 10 years and pay you a larger amount of money. It could pay you for 20 years. But this was the maximum amount of money she could get paid with this particular carrier for the rest of her life. All right. Annuities are structured according to your assets. With the assets of this particular family, this was the annuity that they qualify for. If your assets are $100,000 or more in cash, which means you have at least 6 months to 1 year worth of cash left over in your savings, then there are higher bonus paying annuities that you may qualify for. So, to find out what type of an annuity or what type of an account you qualify for, reach out to me, Richelle Dickerson, at Rama Financial Solutions.net. All right. So now let's take a look at another type of an annuity, which is a growth account. So I'm going to share my screen with you and show you a growth account. Yes, there are life insurance investment companies that pay 50% bonuses on the transfer and the rollover of your account. Now, if you want to know what companies I am referring to, that you would need to reach out to me at Rama Financial Coaching at gmail.com. All right. So now I am ready to share my screen with you. Let's take a look at that same company. That this is a modest bonus paying company. This is someone who may have about 3 months worth of savings. They don't have a lot of money saved for retirement, but back in their bank account, they can do a rollover and keep at least 3 months worth of savings in their bank account. Then this person would qualify for a modest bonus paying account. All right. Are you with me? All right. So this is a modest bonus paying FIA. So this lady is rolling over $597,622.21 from her 401k. After she does this transfer, she has left back $60,000 in her personal money market bank account at the credit union, which means by law, as fiduciaries and financial strategists, you must have at least 3 months worth of your expenses saved up in the bank after you've done the transfer. If you are already in retirement, it is required that you have 6 months worth of savings in cash saved up in the bank before doing anything like this. You must have liquid cash. 401ks are not considered liquid cash because they are owned by the IRS. The IRS owns the money until you are 59 and a half years old. And then you can do a transfer. You can transfer it off your job. You can take ownership of it. But anytime before you're 59 and a half years old, you're going to suffer heavy, heavy tax penalties. All right. So this lady, she decided she would qualify for a modest bonus paying account. And look what happened. When she rolled her money into this growth account, boom, this particular carrier paid her $59,762.22 as free money, as a bonus. Now, most people, when they open up their client portal and they see that free money sitting there, they go, wow, I only made $65,000 a year when I was working. The company paid me almost an entire year's worth of salary. Absolutely. Now, had this lady had just a little more cash assets, a little bit more assets, we could have qualified her for a 15% bonus. Had she had at least a year worth of cash assets, that is before she rolled this 597,000 over, and she still had a year worth of cash assets, not real estate. We're talking about cash that you can put your hands on, CDs, money markets, savings accounts, anything that you can liquidate quickly and get pure cash in your hand. Had she had at least a year worth of cash assets left behind, we could have gotten her a company that would pay her a 30% bonus. Had she been 10 years away from when she needed to take income, which means she could keep that money and let it cook for 10 years before needing to turn on an income, we could have gotten her a growth account or an income account that pays her a 50% bonus. So again, to find out what bonuses you qualify for, you would need to do something called a green sheet appointment with me. That is where you get on with me for about 30 minutes and we complete a green sheet. This will show us what your pure cash assets are. And then it would tell you what carrier, what company you would qualify for and what bonuses you're qualified to get. So if you're interested in setting that up with me, first go to our website, RHEMA, RHEMA, Financial Solutions with an S.net. Book a phone call, just a 15-minute phone call, nothing else, so that we can talk with you on the phone, see where you are, and if everything looks okay after that phone call, then we'll book a Zoom call where you'll set aside about 30 to 45 minutes to complete a green sheet, and then we will be able to hook you up with a carrier that pays you the maximum bonus on your retirement money. Are you with me? Okay. So now we understand that this lady qualified for a modest bonus account because she didn't have more than 3 months worth of cash assets left over after she rolled the money. So she was left back with about 3 months worth of cash assets. And she wasn't struggling, though. She didn't have a lot of debts, because if you have a lot of debts, if you have more debts, and at the end of the month, you're struggling to pay your bills, then you will not qualify for any of these accounts. There's laws and there's fiduciary regulations that are tied in where no matter what you do, if you are in a lot buried in debt, you wouldn't be able to qualify. So we would have to get you to the point where you have cash left over, cash flow after you pay your bills and your debts, and cash assets in the bank. We can help you with that. So then again, reach out at RHEMA Financial Coaching at gmail.com. Send us an email and let's chat and let's see what we can do for you. So she qualified for that 10% bonus. Again, this was the year of the tariffs. So the stock market did crash, but because she's in a fixed index account, she was still able to earn $2,902.29, even during the time of the tariffs and the stock market crash. So this is a bonus account. Notice how it does modest interest rates here, 6%, 5%, 6%. There are boosts in this account. So we have structured the indexes so that she is able to get a boost after the 5th year. And we have accounts that give a mind-blowing boost. If you are able to wait 5 years and then take your money out the 6th year, there is a mind-blowing boost that you're able to get with a lot of our carriers. So she was able to get a boost here of 11% interest, which dropped another $93,221.43 into her account. So she dropped $597,622.21. And then after the 5th year, we touched her right about $1 million. Right about $1 million. Okay. Even though she started with just 3 months worth of savings in the bank after this rollover, if she's able to wait until age 59 and a half, we're going to be tapping on $1 million. Now, listen, we broker our clients, which means once a year, every single year, we do annual reviews. And during this annual review, you will come on with me or whoever your broker is at Rama Financial Solutions, and we will reallocate your account, which means we will switch you from this indexee to that indexee according to how the market is doing. But the beautiful thing is, because it's an FIA, fixed index account, you will never lose a dime. Fixed is the guarantee that the life insurance or the investment company is going to secure your principal. You will never lose a dime. You will only see growth and never see losses. Are you with me? Good news, isn't it? All right. So we've got her just about $1 million. And then what we would want to do is, in order to retire financially independent, you would need to retire on $1 million. So if she can keep this modest growth account, we might switch her to another carrier, honestly, and get her a bigger bonus, because now that she has disciplined herself and she's able to save that money and not touch it for a little while, she actually qualifies for a 30% bonus now. But even if we kept her with this carrier at age 62, when she hits $1 million, we are going to take this, and what are we going to do? We're going to annuitize. We're going to annuitize this $1 million. So what I'm doing is I'm taking that $1 million and I'm copying it, and I'm staying inside the same carrier, and I'm just dropping it in their income driver. All right. So if you can see what I'm doing, so I am dropping it into an income driver. Okay. So I dropped $1 million. I'm going to change her age to 62. And then I want to have her take the money as a guaranteed lifetime income. So I want to know, how much is this company going to guarantee her? There are people who like guarantees, right? We don't want to guess what our income is. We want guarantees. We're also going to add an income doubler onto this annuity. What does that mean? That means if she needed long-term care, which the doctor told her she was chronically ill, She couldn't do 2 out of the 6 daily living tasks. She could file a claim against this annuity and they would double her income and pay it out to her. Now she has to be fully vested in this annuity for 3 years before she would qualify to double her income for long-term care. Now, most carriers do have that as a rider. It's called a wellness benefit. So if you do get one, you want to make sure you ask for it. Okay. So now let's take a look and see what happens. We're going to turn that $1 million into $69,231.34 guaranteed on the floor as a lifetime income. Now, as a broker, I know beyond any reasonable room for doubt that we can take that $1 million up as high as $100,000 a year. Okay. So we have different boosts. We have different indexes. We have some secret sauce. We have different carriers where we can get her to a guarantee of $100,000 a year on the floor. So when we say on the floor, that means a guarantee, or that's the floor, which means you don't have this money in a variable annuity, which means if the stock market crashes, you're going to lose your money. Your money is sitting on the floor in a fixed index account. So we'll put $100,000 on the floor if she allows us to be her broker, and then boost her account, switch it to different indexes. We are right there mixing the sauce for her. So all she has to do is plug in and reallocate her account with us at least once, maybe twice a year. But just modestly, this carrier is saying they're going to guarantee her a lifetime income of $69,000 plus per year. Well, guess what? That plus her pension, that's going to put her over $100,000 a year. So she's going to be making more money in retirement than she did when she was working. Let's say something happened and her body was stricken with arthritis. She had to get a hip replacement, but she still had arthritis here and there. And then her eyesight went and she wasn't able to drive herself anymore. And she needed a nurse to clean up her home, or somebody to come by and help her with her medication. Or maybe she needed some help cleaning up her home because she's not as mobile as she used to be. And the doctor told her she qualifies for a disability, or she's considered chronically ill. Well, guess what? She can file a claim against the annuity, and guess what they'll do? They will double this income to $138,462.68, and they will pay it to her for 1, 2, 3, 4, 5 years. This will get her through the hardest part of long-term care. That is the beginning. Because in the beginning of long-term care is when you need your hip replacement, your knee replacement. You may have to hire people to do your yard work, to clean your house. Family members have to come by maybe and help you cook and different things like that. So if you can get through the first 5 years and double your income, you're able to hire the people that you need to hire. Once you got yourself settled in, then the income went down to the guarantee of $69,000, right? Now, suppose she had put this money in a brokerage account and not in this annuity. Well, she would not be able to double her income because they don't have any kind of life insurance or any kind of health or wellness insurance. There's no insurance on her money. So she can't file a claim against a brokerage house because she needs long-term care. She's just going to be withdrawing her money down to the line of zero and hoping and praying that the stock market doesn't crash, right? But here, what would happen if she was in a brokerage account? If she tried to withdraw this $69,000 out, she would be down to the line of zero at age 73. She would be flat broke, as you can see here. But because she has insurance on her money, she is guaranteed never to lose a dime and never to run out of money. So here she is, over 100 years old, and she's still getting that guaranteed $69,000 for the rest of her life. Now, with this, I want to tell you a story. And I want to tell you the story of my mom. My mom started getting an annuity when she was 22 years old. My dad was a DC police officer, and my dad was shot in front of me and my mom in Chapel Oaks, Maryland. So my mom began to get an annuity check from his pension, because a pension back in those days it's the same as a fixed index annuity. You have a guaranteed lifetime income. So those of you who have pensions, you understand what a fixed index annuity is, because a pension is actually a fixed index annuity. They're one and the same. Not an account, but it's an annuity because it pays you a lifetime income. Not an account, but an annuity. Are you with me? So my mom began to get $1,200 and some change per month back in 1969. She got the $1,200. That was a good amount of money back then. My mom was a single mom at that time. I was about 2.5 years old. So my mom bought a house. She bought a townhouse. She was able to pay her car off. She was able to sustain our life. As a matter of fact, I went to the University of Maryland, College Park, because of that annuity that my dad had left back for us. My mom is now 80 years old. She turned 80 July the 8th of 2025. Do you know that my mother is still getting that $1,200 a month and some change from the annuity that my dad had back in 1969? Now, I want you to imagine a 22-year-old police officer who worked in the DC government only for a short amount of time, maybe just a few years. And he was able to sock away money into that pension. Maybe if he was lucky, he put $100,000 in there. Who knows? And that $100,000 produced a lifetime income that lasted 54 years. 54 years. That annuity has been paying my mom. And I want to tell you that it rescued her and I financially. It rescued us out of the miry clay, as the Bible would say, time and time again, decade after decade after decade. So as you can see, because of my family experience, I'm a strong believer in a fixed indexed annuity. Now, if you have some money on the stock market, great. Make that your tier 3 money, which is the money you can afford to lose. But I want to admonish you to put a fixed indexed annuity on the floor so that when the stock market crashes, you don't lose a dime. My name is Richelle Dickerson. I'm the CEO of Rama Financial Solutions, and I am a financial strategist. I've been in the industry since 1992. I love what I do. We also do life insurance, whole life, universal life, index universal life, and we cover people all the way up to age 80, regardless of health. So if you see something that sparked your heart and you feel like you should move towards me and our firm, again, reach out to me and book a call on our website, Rhema, RHEMA, Financial Solutions with an S.net. And I'm here for you, and I can't wait to meet you. Until then, stay blessed.